In today's Property Insider video, Dr. Andrew Wilson and I discuss how APRA's sledgehammer approach is impacting all housing markets regardless of their affordability status. We're also going to explain why we think there are going to be more interventions by APRA. We talk about unemployment, building approvals, housing starts, and our auction markets. Lots of news in this week's Property Insider video. If you want to keep up to date with the latest property information, please subscribe to our YouTube channel and click the little bell icon so we can let you know when a new show comes out. There's now a light at the end of the tunnel, and that's great for our well-being, our lives, and our property markets. With COVID-related restrictions slowly being lifted in Sydney and Melbourne, life's getting back to a more COVID normal, and the pent-up demand from the last couple of months should ensure our property markets continue to perform strongly moving forward. Only last week, Westpac upgraded its forecast for Australian dwelling prices again. They're now expecting property prices to rise 22% for the full calendar year, this year 2021, and they've also lifted the outlook for next year from 5% to 8%. But how are APRA's interventions going to interfere with this? That's a question Dr. Andrew Wilson and I have discussed in these weekly Property Insider videos over the last couple of weeks, but I'm keen today for him to share with us his thoughts on affordability and how this differs in the various states. There's lots of property news to discuss this week, so I look forward to my chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yes, hello, Michael, and we can continue to, promote all the good news that's coming forward after the gloom of the never-ending lockdown of winter and early spring we've all just lived through.
Yes, well, there's only a few weeks left to go, and life is getting, this year, I shouldn't say left to go altogether, and life's looking like it's getting more normal again. Now, I know we've spoken about APRA a lot, and the media has, but there was an interesting angle that you put on it in a recent release which said that APRA's sledgehammer is impacting all housing markets equally, regardless of their individual affordability levels, Andrew.
Well, this has always been a problem with APRA's actions to, tap the brakes on housing market activity. We saw it back in 2015, again in 2018, with those concerns that higher interest rates may cause disruptions in the marketplace. So those that were perhaps over leveraged were exposed, and APRA therefore wanted to reduce the risks involved in that potential higher interest rate environment from the exposure of banks. And that, of course, is their job, is to risk manage the banking sector. The problem is that it's a national policy, so those changes or those restrictions to lending affect all borrowers Australia-wide. And it's the same scenario here. We know the buffer's been increased from 2.5% to 3%. So when you go to get your new loan, you agree on an interest rate, and then you have to be able to show that you can afford to cover a 3% increase in that interest rate in terms of your income capacity. And that, of course, is to guard against higher interest rates in the future, to make sure that you can repay it without any risks to the banks. Now, as we've discussed a number of times, Michael, there's more holes in that argument than Swiss cheese. We won't go into that again, but I think one of the issues that we do confront is the fact that it is a blunt instrument that affects all housing markets, regardless of their level of risk at the moment. And APRA measures risk in regard to income and loan size. So as loan sizes are increasing faster than incomes, they're concerned that there won't be the capacity to repay, given a potential environment in their mind of higher interest rates. Of course, we know that's some way off. We only have to ask the Reserve Bank, and they continue to tell us that's 2024. But when we do look at the comparative position of state housing markets, Michael, in terms of the proportion that the average income takes up with the average repayment, we can see that there's a big difference between the states. Firstly, when we see the change in that proportion, which measures income affordability over the past year, no surprise that New South Wales and Victoria, reflecting Sydney and Melbourne's boom markets, have leapt ahead of the other states and their capital cities in terms of affordability declines. And with 20% plus prices growth in a year, there's no surprise that new borrowers are maxing out their income capacity to keep up with higher prices. So from that point of view, we've clearly seen a rise in Melbourne, Sydney, New South Wales and Victoria compared to the other states, or if there was any concerns perhaps as to the outlook with higher interest rates maybe on the horizon, according to APRA, then it would be clearly reflected in those particular markets, which are well in excess in terms of falling affordability compared to the other state markets. And when we do create a relativity index, Michael, with that affordability model, we can see that Sydney is well ahead of the rest in terms of relative affordability. Again, it means that those smaller states which don't have that same elevated risk profile when we measure incomes versus loan repayments, it means that they have to pay the price as well. And that means that it's going to be tougher for them to get a loan, just as it will be those in Sydney, Melbourne, New South Wales and Victoria, where affordability has declined. And of course, if we do see APRA moving into the market again, which I think is now likely, given, as you suggested, there's certainly a rebound in housing market activity post-lockdown. We've seen some remarkable numbers now in new listings coming out of Sydney over the past fortnight. Melbourne, we've seen 7,000 extra new listings coming into that Sydney market. And we're seeing record numbers of new listings on a weekly basis coming into the Sydney market. No surprise, but of course that will only increase the activity in the Sydney housing market, which is already at sky-high levels. So the problem is that if there are other actions taken by APRA, it'll affect all our housing markets, regardless of the nature of their local markets. And we saw that back in 2015 when APRA directly targeted investors. Investor activity then was very strong in the Sydney market. So there was probably a case there, or if there was a case, it was certainly in the Sydney market, to reduce investor lending. However, investor activity in all other capital city markets at that time was around about average levels. But maybe we're paying the price for that now, particularly given a shortage of rental properties, reflecting that collapse in investor activity that followed those APRA actions. And we wouldn't want to see those types of consequences occur again, Michael. And of course, that just does reflect the market power that the big four banks have, cover most home loans Australia-wide. And of course, as APRA acts on behalf of the big banks, it reflects the market power and the capacity that APRA does have to manipulate housing markets. And their brief is just to manage risk for the banks, and that's fine, and you can understand their focus on that. But the real issue is whether that market power can produce negative consequences, not just for housing markets, but also for the economy in general. So it'll be interesting to see if they do act again. But once again, if they do, Michael, it will affect all housing markets, not just those that are notionally more risky given higher house prices.
Well, you mentioned there are many more listings coming onto the market, which may make some people think, oh, more properties for sale, there won't be as much competition, prices will go down. But it's got to be remembered that most people putting their properties on the market, they're also buyers, because they're now going to want to upgrade, downgrade, move into a different location. So it's going to increase market activity, but it doesn't mean there's going to be a flood of properties around without people wanting to buy.
That's right, Michael. This market has been clearly characterised as a changeover buyer market. Owner-occupiers, also first home buyers, but certainly the great majority of activity has been through owner-occupiers, and that means changeover buyers. So that flood of new listings coming into Sydney also means we'll get a flood of new buyers as well. And as most buyers are sellers and sellers are buyers. But it'll certainly test buyer depth, which is interesting, Michael. We may have seen some early signs of that on the weekend. We've certainly seen a lot more, reflecting new listings, a lot more auction numbers coming into the marketplace. Auction numbers lag total new listing numbers because auctions are booked in typically 4 to 6 weeks before the event or before today's date. We saw a slight ease in clearance rates across the board, everywhere except Melbourne. Still very, very strong, let's be clear. But auction numbers will rise very rapidly over the next month or 2 months, Michael, which typically happens at this time of the year. That'll be accentuated by the end of lockdown, as those sellers who've been sitting on their hands can now get back into the marketplace. So it'll be interesting to see how this does test buyer depth. Of course, we've had in Sydney clearance rates above 85% for over a month. It did fall under 85% at the weekend. But we've had 13 weeks in a row in Sydney with clearance rates above 80%, so that's quite phenomenal. And Melbourne has been tracking very close to 80%, even recently, even with still quite severe restrictions, which of course are now easing. So I would expect to see those Melbourne clearance rates start to push upwards over 80%. But the key interesting point will be with a flood of new listings coming into the market, whether at the rate of which they will be absorbed. And we do see clearance rates falling as stock numbers rise towards the end of the year. But it has exacerbated or elongated perhaps the cycle, and we will expect to see more activity pushing through into next year. And those that test themselves with predictions of house price growth, again, of course, which we're used to, are making some changes to their forecasts going forward. But it is a heady market, Michael, going forward. Prices will continue to rise. They're still rising at around about 2% a month at the moment in Sydney, around about just under 1% a month in Melbourne, no surprise. But there's plenty of upside to housing market activity now that we're thankfully moving out of the severity of lockdown.
Apart from the two big capital cities, your chart here also shows that the smaller capital cities did really well over the weekend in the auction market.
Yes, higher numbers again coming forward in the smaller capitals, Michael. And as I said, we expect that this time of the year anyway, but particularly amplified by the end of lockdown. Canberra's now moving out of lockdown as well. Their numbers are up. Clearance rates were down slightly in Canberra and Adelaide at the weekend, but let's not quibble. They were still pushing towards 90% clearance rate. It is a sign. It's the very earliest of signs that buyer numbers are starting to push downwards compared to seller numbers. This is still a remarkable market, one the like we haven't seen before, really, in terms of its consistency and in terms of the evenness of capital city performances.
Over the last week, there's also been some news about employment and jobs. And the headline said that there were 281,000 Australians lost their job because of Delta. And this was particularly in Sydney, but also Melbourne, related to the times a couple of months ago. These are backward-looking figures, Andrew, that shows unemployment went up a bit, participation rates went down, but the more recent statistics are suggesting that there's lots more jobs being advertised and we're working our way through this.
Absolutely, Michael, and no surprises in that latest data, which of course is the September data. I think the interesting point there is that we're still holding our unemployment rate with a 4 in front of it now. It is exaggerated, that low unemployment number, by the participation rate. Fell again sharply. So that means we're not measuring as big a pie as we usually do. So as the employment numbers fall, the participation rate is falling at the same level. So that keeps the unemployment rate at around about the same level. But of course, we saw clearly the impact on the national rate was from the Victorian numbers, from the Melbourne numbers. There was a big fall in employment in Victoria, down 3%, more than 3% over the month. And there was also obviously a big fall in the participation rate there as well. So that helped to keep the Victorian unemployment rate reasonable in the face of a lockdown. And again, I think that the prospects now are quite positive going forward, where we will land once our workforce does start to engage itself again in the sort of proportion that we've had prior to the recent lockdowns. And there's no doubt that the Sydney economy is re-energising quite quickly at the moment. And I would expect to see the Melbourne economy follow suit similarly over the next month or so. But still, given the severity of the lockdown, to still have an unemployment rate, notwithstanding the participation rate, with a 4, remembering that we got well over 7 last year in similar circumstances, it just shows that we're a little bit more perhaps immune to these circumstances, and that'll mean we'll bounce back quite quickly. And I think we've sort of discussed that before, that the prospects are certainly a lot better coming out of lockdown this time than they were a year ago. And as I said, those numbers will reverse themselves in terms of the participation rate and the employment numbers increasing, I think, over the next month or two quite sharply.
I agree with that. In fact, I know some employers are having difficulty filling jobs at the moment. That's going to be a challenge moving forward, particularly in the building industry.
Yes.
And activity in the home building sector has been very buoyant. The latest statistics suggested commencements of the June quarter boomed. They rose 23.2%, the biggest quarterly rise in 20 years. Now, the starts were mainly in houses, but
Yes.
apartment dwellings are starting to pick up as well, Andrew.
Yeah, of course, we're seeing the back end now of the end of the home builder policy, Michael. We've seen a decline in home building approvals. No surprise there. House approvals have been at record levels as a response to that policy. They've come back quite sharply, and that's to be expected. But there are some surprises. The last month actually saw building approvals hold up. This is, of course, August, hold up against the trend. When we look a little closer at the data, Michael, we can see it's actually Melbourne and Sydney that are holding the line. The other capital cities continue to fall because of the lack of the drive from home builder. But Melbourne and Sydney have held up with house approvals, particularly Melbourne. So it's continued to, certainly not at the very high levels of earlier this year, but not far away at the moment, which I think is quite interesting, particularly the Melbourne market has continued to move ahead with that house building energy, which is always very typical of Melbourne. And as you said, I think that's a very good sign for the economy going forward. It means that there won't be, a back end in terms of lower economic activity as a result of the finish of the home builder allowance. New approvals are continuing to come through that aren't being driven by home builder at this stage. The other interesting point, Michael, was in apartments. And we have seen certainly the apartment cycle, which reached in real terms a record low point and has been falling dramatically since 2016, as we've discussed, a reflection of those tight lending conditions, particularly on investors. But we have started to see the base form now in apartment development, and it is starting to rise. No surprise, it's coming out of Sydney. Sydney has seen an increase, a modest increase in underlying apartment approvals. But Melbourne also, Michael, is moving ahead with new apartment approvals, and their numbers are holding up quite well. And Brisbane also has shown a significant revival in apartment development. Moving out of that down cycle for apartment development, which did reach almost ridiculously low levels, Michael, we're now starting to see, I guess, those underlying forces pushing up demand for apartments, and we're moving back into more of a normalised environment in terms of the balance between new developments for houses and new developments for apartments. So some good news there, really. And of course, apartment development is very labour intensive, and in terms of its longer term generation of jobs and economic activity, that's a very positive sign for the national economy.
Another positive sign, of course, is that when people move into these dwellings, they need new fridges and televisions and carpets and curtains. And so there's going to be flow-on effects in the economy.
Absolutely. And that's what we missed out on when we saw the collapse in apartment development from 2016 onwards. And it is now, it's still well below where it was then. Let's not get too excited, but it's on the way up again. And hopefully planners, regulators, and financiers will take this on board and realise that there is certainly a lot of underlying demand for apartment living, and that will only increase going forward. And we're likely to see a shortage of properties given how the length of production horizon for apartments and the prospect of borders now opening up again, Michael. And hopefully that means particularly students and tourists coming back into the market in the sort of numbers we're used to.
That'll be really nice. Well, spring is the time of green shoots and new beginnings. And I think that's happening in our property market. So I look forward to having a chat with you again next week when we're going to bring some more good news. Absolutely, Michael. And the interesting points for next week will be the inflation numbers for the September quarter are going to be released. I think we're going to get a lot of media over that. There should be some big numbers coming out. We're still adjusting from last year's low inflation as a result of COVID and lockdowns, but it'll be a big number. And of course, if we do get a big number for inflation, it will set the higher interest rate dogs running. You can bank on that. Yes, there'll be some interesting stories coming out of that. Look forward to chatting with you next week, Andrew. Thanks, Michael. Bye now.